Welcome to Griffonomics.
Glad to be here.
Imagine trying to build an e-commerce empire, right? Like on the scale of Amazon.
Oh, wow. Cool.
You've got tens of thousands of products, thousands of suppliers, a massive customer base. But there's a catch.
There's always a catch.
Right. Almost every major bank, payment processor, and software provider basically refuses to work with you.
Man, that is a nightmare scenario.
It really is. If you use standard tech, you risk getting shut down overnight. So today we are looking at GrabAGun.
Ah, yes. Trading on the New York Stock Exchange under the ticker PEW.
Exactly, PEW. They're often dubbed the Amazon of guns. And the mission for this deep dive is to perform a granular inflection analysis on how they survived that exact scenario.
It's a fascinating transformation.
It is. We are tracking their fundamental shift from, just a digitally native retailer into what's rapidly becoming the primary logistics and compliance infrastructure for the entire firearms industry.
And this is a highly, highly regulated space.
Very. We've got a great stack of sources today: financial reports, earnings, call transcripts, strategic analyses. But before we get into the mechanics, I want to speak directly to you, our listener.
Yeah, we need to set the stage here.
We do. Because our sources today contain some politically charged themes. We're going to be discussing concepts like ESG mandates, debanking, and the creation of a parallel economy.
Heavy topics.
Right. So I want to explicitly clarify right now that we are not taking a side or endorsing any of these viewpoints. Our goal here is simply to impartially report on the ideas contained in the original source material.
Exactly. Just so you can understand the underlying mechanics of the business.
Right. And the context of those mechanics is really the entire hook of this analysis.
Yeah, I mean, we are dissecting a company operating in a sector that is completely starved of traditional capital. Private equity has, largely just walked away.
Walked away completely.
And major commercial banks are super hesitant to lend. Yet somehow, in that environment, GrabAGun has built a massive cash war chest.
And an entirely independent tech stack.
Which is a glaring contradiction.
Mm-hmm.
I mean, how does a company in such an underfunded, scrutinized sector build this cash-rich fortress while competitors are basically just struggling to keep their merchant accounts open?
Okay, let's unpack this by starting with what they actually look like today.
Good place to start.
They are fundamentally a tech-first retailer. And the scale is just wild. They boast a catalog of roughly 73,000 products.
Wow.
Yeah, sourced from over 2,000 different manufacturers. And historically, their revenue is driven by three main pillars.
First being retail e-commerce, right?
Which makes up the bulk of it. Firearms represent about 84% of those sales.
Makes sense.
Second is their financing arm. That generates about 8% of revenue through a partnership with Credova. It's like a shoot now, pay later service.
Oh, interesting.
Yeah. And third is a newly launched stream of logistics fees. But the real story here is the underlying technology.
It always comes down to the tech.
It does. To bypass that very real threat of mainstream deplatforming by tech giants think of Shopify or PayPal just pulling the plug to those. GrabAGun built its entire enterprise resource planning software in-house.
And their ATF compliance software, too.
Completely from scratch. It's like a store building its own power plant and municipal water supply just to make sure the landlord can't evict them.
That defensive posture is where the best business mechanics usually start, honestly. Because they couldn't rely on off-the-shelf software, they spent 15 years writing code.
Starting in a literal garage in Texas.
Yeah. Writing code to handle the incredibly complex nature of moving firearms across state lines. They built what management calls an uncancelable stack.
An uncancelable stack.
I like that. And this defensive strategy accidentally forged a massive competitive moat. Like, think about normal e-commerce. If you want to sell coffee mugs, you could spin up a Shopify site in an afternoon.
Easy. Couple of clicks.
Exactly. You use standard plugins for shipping. But if you want to sell firearms online, legally across 50 states, while managing thousands of hyper-local municipal regulations.
You definitely can't just rent a software suite for that.
No, you can't. GrabAGun built the invisible plumbing that makes that legal labyrinth navigable. And that plumbing is excruciatingly difficult for any new competitor to replicate.
But they didn't just stop at survival plumbing, right? They took that in-house tech and turned it into a highly aggressive offensive weapon.
Yeah, they really did.
Take their new inventory program, or NIP. This isn't just like a basic spreadsheet keeping track of the warehouse.
Oh, far from it.
They're running a proprietary AI-driven dynamic pricing algorithm called PMO.
product margin optimization.
Right. And this AI is crawling competitor websites every 30 minutes. It constantly analyzes market supply, competitor pricing, and consumer demand.
And then it optimizes GrabAGun's prices and margins in near real time across all 73,000 SKUs.
But let me push back for a second. If they're having an AI adjust their pricing every 30 minutes, are they acting more like a Wall Street high-frequency trading firm than a traditional sporting goods store?
What's fascinating here is that high-frequency trading comparison is actually the best way to understand their strategy.
Really?
Yeah. In a highly fragmented industry full of, independent mom-and-pop gun shops, GrabAGun is bringing Wall Street-level quantitative analysis to sporting goods.
Oh, I see.
Imagine a specific rifle suddenly goes viral online. A human store manager might notice a spike in sales 3 days later when they check a weekly report.
And by then they're sold out.
Exactly, sold out at a normal margin. But GrabAGun's PMO algorithm notices within 30 minutes. It recognizes the supply shock and automatically raises the price by, say, 5%,
Capturing that premium demand.
while still remaining slightly cheaper than the next available competitor. The AI is squeezing maximum profitability out of every transaction without any human intervention.
That perfectly explains the retail side. But you mentioned compliance earlier. They built their own proprietary software called eGunBook.
Yes, eGunBook.
And the sources note it actually received a first-of-its-kind ATF approval for digital form 4473 storage, digital signatures, and automated serial number tracking.
Right, across a network of thousands of local pickup locations. And its compliance automation is where the true operational leverage lies. Maybe even more than the AI pricing.
Really? Why is that?
Well, look at the traditional process. A mom-and-pop shop gets a shipment. A human employee has to log the serial number by hand into a physical, bound paper book.
Sounds tedious.
Very. And when the buyer arrives, they check the ID, fill out a complex paper federal form, and file it in a metal cabinet for decades. It is an excruciating, error-prone life cycle.
And a single mistake is a huge deal, right?
Oh, a smudge number or a forgotten checkbox can trigger a catastrophic ATF audit. But GrabAGun's eGunBook automates almost all of that agony.
How does it work?
When a barcode is scanned in their central warehouse, the software instantly verifies the local dealer's federal license is active. It cross-checks the federal database, logs the serial number, handles the data digitally.
Wow. So they can process a massive volume with near perfect accuracy.
Exactly. Something a traditional retailer just physically cannot match without an army of compliance officers.
Which brings us to the core strategic inflection point of this entire deep dive. They spent a decade and a half using this incredible tech strictly internally.
To become a massive retailer.
Right. But now they're at an inflection point. They are taking that exact battle-tested tech and renting it to the rest of the industry.
This is the pivot.
They recently launched a wholly owned subsidiary called PEW Logistics. It's a white-label business-to-consumer fulfillment platform.
B2B2C.
Exactly. Essentially, manufacturers like Keltec Weapons and Derail Arms are using it to run direct-to-consumer storefronts.
Right. So if you go to Keltec's website, the site looks like Keltec, the branding is Keltec.
Yeah. The customer thinks they're buying directly from the factory. But in the background, PEW Logistics is handling the entire transaction. The compliance, the FFL processing, inventory, shipping.
It's all GrabAGun.
And to me, the sheer brilliance of this is how it eliminates what marketers call referral leakage.
Yes. Referral leakage is a massive silent killer of revenue in regulated industries.
Let's walk through the mechanics of that.
Okay, so historically, a manufacturer spends $50 on a highly targeted digital ad. A customer clicks it, goes to the site, wants to buy right then.
But they can't.
Right, because the manufacturer couldn't legally process the direct-to-consumer sale. So the site just displays a button saying, find a dealer near you.
That's so frustrating for a buyer.
And for the brand, the customer clicks away, goes to a directory, gets distracted, or walks into a local store and gets upsold onto a competitor's product. The manufacturer paid for the marketing but lost the sale.
But PEW Logistics changes that paradigm.
Exactly. It lets the manufacturer keep the customer on their own site, capture the consumer data, and finalize the sale immediately, while GrabAGun does the heavy, regulated lifting in the shadows.
And doing that heavy lifting in the shadows fundamentally changes the economics for GrabAGun itself.
It really does.
Traditional retail is a simple formula buy at wholesale, sell at retail, pray the margin covers your overhead. But PEW Logistics operates on a sauce-like pricing model.
Software as a service.
Right. Instead of taking inventory risk, GrabAGun charges these manufacturers setup fees, recurring monthly platform fees, and then takes a revenue share on every single transaction.
And since the tech is already built, adding a new manufacturer has very little incremental cost.
Which promises structurally higher profit margins. However, moving physical products is vastly harder than moving software.
Oh, absolutely. Software scales infinitely. Heavy metal boxes do not.
Exactly. So to support this physical network, GrabAGun recently utilized an $8.5 million delayed draw term loan to buy a massive new 44,500 square foot facility in Farmers Branch, Texas.
That physical expansion is a critical indicator. You don't increase your footprint by 2.5 times on a whim.
No, you don't.
It is specifically to support the volume they anticipate PEW logistics will generate. But buying warehouses requires immense capital. And remember, our initial hook, this industry, is capital-starved.
That transitions us perfectly into their financial realities. Let's look at their fiscal year 2025 review, because the numbers are, well, they're counterintuitive.
They really are.
I'll start with a top-line acceleration. In the fourth quarter, their net revenue grew 14.1% year over year, hitting $29.6 million.
And we have to contrast that 14% growth against the broader macroeconomic environment.
Right. How did the rest of the industry do?
Well, during that exact same period, adjusted national background checks, which is our best proxy metric for overall sales volume, were actually down by about 4%.
Wow. So the broader industry is actively shrinking.
Shrinking. Yet GrabAGun is accelerating by double digits. They're capturing significant market share from legacy competitors.
And they aren't just selling more, they're making more on what they sell. Their gross margin hit 15.9% in Q4.
That's huge.
The reports note that is up 290 basis points from the year prior.
Which, in plain English, means their profit margins jumped almost a full 3% in a single year.
A massive leap in retail, driven mostly by that AI pricing algorithm and strategic buying. But here's where it gets really interesting.
The balance sheet.
The balance sheet itself. Following a successful SPAC merger in mid-2025 with Columbia Acquisition Corp., GrabAGun exited the year with $110.4 million in liquid cash.
And zero debt on the retail side.
Zero. Having 9 figures of cash sitting untouched in a bank account in an industry where local credit unions routinely refuse to issue basic business credit cards, it's a staggering, almost unfair advantage.
It is the ultimate strategic war chest. And the mechanics of how they got it deserve a closer look.
Remind us how a SPAC works.
Right, a special purpose acquisition company. It's essentially a shell company that raises money, goes public, and then searches for a real business to merge with.
And they've had a brutal reputation lately, right?
Oh, terrible. Usually when a SPAC announces a merger, the initial investors get nervous and redeem their shares. They demand their money back before the deal closes.
Leaving the target company with hardly any cash.
Exactly. But GrabAGun's merger with Columbia II featured essentially zero shareholder redemptions.
Zero. That's unheard of.
The market believed in the underlying thesis so strongly that almost all the cash held in trust transferred directly onto GrabAGun's balance sheet.
Now, the reports do mention they reported a GAAP net loss of $2.5 million for the full year 2025.
Right. Generally accepted accounting principles. The strict rules.
Right.
That GAAP net loss is true on paper, but we have to look under the hood.
What's driving it?
It was largely driven by massive, one-time, stock-based compensation and transaction expenses related to going public. If you strip away those paper expenses and look at adjusted EBITDA.
Which measures actual cash generation.
Exactly, they were actually positive. Furthermore, management expects core operations to be fully cash flow neutral in 2026.
So they don't have to burn that $110 million just to keep the lights on.
Not a dime. Every single dollar of that reserve can be deployed for aggressive, outward growth.
Which begs the obvious question. How exactly do you spend $110 million to corner a highly fragmented market?
Acquisitions.
Let's dive into their strategic catalysts and consolidation plans. With private equity abandoning the sector, GrabAGun is positioning itself as the premier industry consolidator.
Buying up the lagging Web 1.0 competitors.
Right, those older websites from the early 2000s, incredibly loyal customer bases, but terrible, clunky user interfaces.
They plan to buy those dinosaurs at a discount, plug their customer lists directly into that in-house AI and logistics stack, and force immediate profitability.
Just stripping out the legacy inefficiencies, they're also moving aggressively to capture Gen Z and Millennial.
They're getting into crypto, right?
Yeah, they recently became the first major firearms retailer to accept cryptocurrency natively at checkout. Bitcoin, USDC, USDT.
Smart move for that demographic.
Plus, they launched a program called Shoot and Subscribe. It brings recurring, automated subscription revenue to ammunition sales.
Like a coffee pod subscription.
Exactly. Completely standard in the razor blade industry, but revolutionary here.
If we connect this to the bigger picture, you start to see the outline of a philosophy their leadership calls the parallel economy.
The parallel economy.
Yeah. The firearms industry has faced intense capital starvation due to ESG mandates from major Wall Street institutions.
Environmental, social, and governance.
Right. Many traditional banks and tech platforms simply refuse to do business with them as a matter of policy. GrabAGun recognized this not just as a hurdle, but as a generational opportunity.
To build a closed-loop system.
Look at their board of directors. They brought on high-profile, politically connected figures like Donald Trump Jr. and former NRA executive Chris Cox.
That's a strong signal.
It transcends merely selling sporting goods. They are explicitly aiming to build an ecosystem that is structurally immune to ESG capital starvation. By controlling the tech, logistics, and having a massive cash reserve, they are constructing a parallel digital economy.
Stepping in to provide the infrastructure Wall Street denied them. But as with any hyper-growth story, there are always vulnerabilities.
Absolutely.
The sources are very clear that despite the fortress balance sheet, there are real structural cracks. So what does this all mean when we look at the market skepticism and the risks?
First up is the accounting.
Right. Management explicitly disclosed material weaknesses in their internal control over financial reporting. They stated they lacked sufficient personnel and had a lack of segregation of duties in accounting.
That's a big deal.
Let me push back on the entire bull case right here. If management admits there are material weaknesses, how confidently can you, the listener, rely on those stellar Q4 margin numbers we just talked about?
This raises an important question about the profound, sometimes painful growing pains of transitioning from a private startup to a publicly traded giant.
It's a huge jump.
The internal control weaknesses are classic symptoms of a company whose operational complexity outpaced its back-office staff. When you're private, having one person handle multiple financial roles is normal.
But when you're public...
That lack of segregation of duties is a massive compliance failure. The filings note they are actively hiring specialized accounting firms to fix this, but it is a glaring red flag.
The numbers might be accurate, but the process to verify them is currently flawed.
Exactly.
Then there is the existential threat of debanking. It never really goes away no matter how much tech you build.
Because you still need normal banks.
Right. For wire transfers, employee payroll, corporate treasury functions, that carries a latent political sensitivity risk. And financially, there is a massive warrant overhang.
The SPAC warrants.
They have 10.6 million SPAC warrants out there, exercisable at $11.50 per share. If the stock takes off, those convert into real shares, severely diluting current shareholders.
That warrant overhang is a mathematical reality that caps short-term upside. But we have to look at how management is responding.
They authorized a buyback, didn't they?
They did. A $20 million share repurchase program. And they actively bought back $8.9 million worth of their own stock throughout 2025.
So insiders believe the intrinsic value is higher than the trading price?
Yes. And it's a proactive measure to soak up shares and manage that future dilution. But the risks, from accounting bottlenecks to debanking, are undeniably real.
Bringing all these investigative pieces together, it is time for our final verdict on GrabAGun's trajectory.
The final assessment.
Based on the financial momentum, the structural advantage of the PEW logistics B2B2C model, and their unique capital position, the strategic outlook for PEW is rated high growth but speculative.
They really are uniquely positioned as the premier consolidator.
They spent 15 years building the power plant and the water supply to protect themselves, and now they are aggressively selling those utilities to the rest of the town.
I'll leave you with a final provocative thought to mull over. GrabAGun has essentially drawn a highly detailed map of how to survive and thrive when mainstream corporate America decides it doesn't want your business.
A blueprint.
Exactly. If GrabAGun successfully scales this highly profitable, fully independent, uncancelable supply chain, what other controversial, heavily regulated, or politically sensitive industries might look at this exact blueprint to completely bypass mainstream tech and financial gatekeepers.
Risk defined, portfolio protected.